Welcome to the Daily Drawdown, your fast brief on AI money, market stress, and what matters now. The market still loves AI growth, but the real story is shifting underneath it. Capex is exploding, debt is piling up, and the next phase is about financing, power, and actual returns. The headline is simple. Hyperscaler AI buildout is still accelerating. Goldman now sees roughly $1.1 trillion in 2027 capex across the four biggest cloud players, up from about $800 billion this year. That keeps chips, memory, networking, and power spending supported, but investor tolerance is changing. The market wants token-level ROI now, not just bigger clusters and bigger promises. What matters next is whether management teams can show that all this spending turns into either clear efficiency gains or real revenue growth. The second-order effect is credit. Goldman put AI-related debt financing at $489 billion through July, and Morgan Stanley said June alone saw $77 billion of AI-related issuance. That fee pool is good news for investment banks, especially Goldman and Morgan Stanley, but it also raises the risk of spread widening and repricing if yields stay high. With the 10-year near levels that have people talking about 4.8% and potentially 5%, financing models built on cheap capital start to look weaker fast, especially for lower-quality AI borrowers. Semiconductors are still doing an outsized amount of work for the broader market. One data point showed Micron and NVIDIA alone adding roughly 790 basis points to second quarter S&P earnings growth. Since semis are about 18% of the index, strength here can hide weakness almost everywhere else. That matters if you're reading headline index performance as broad health. The recent rebounds in names like Micron, Marvell, Western Digital, Seagate, and SanDisk look partly like oversold snapbacks, but they also have structural support from AI demand and tighter pricing. TSMC is planning wafer price increases for 2027, with reports around 5 to 10% across advanced and mature nodes. That helps protect TSMC margins, but the cost doesn't disappear. Some of it is likely to pass through the chain. Hyperscalers may be able to absorb that for AI workloads. Consumer hardware companies have less room, so watch for margin pressure or eventual pricing tension there. Alphabet's cloud results are one of the most important checks on the whole AI trade. Consensus has cloud growth around 63%, with whispers closer to 70%. Investors are focused on whether Google can show that TPU efficiency, cloud demand, and monetization are catching up to the spending. The signal here is especially sharp because Alphabet nearly doubled AI capex, stopped buybacks in the first quarter for the first time in a decade, and is clearly asking investors to accept near-term cash burn. Open models are lowering access barriers, but production AI still isn't cheap. The real cost is integration, hardware, networking, operations, and getting the system to work reliably at scale. That means incumbents still have meaningful advantages even if model weights are open. A split is emerging between frontier models and cheap specialized models. Cisco's small security models can run on a single GPU and work as a loss leader for broader software revenue, while Google is pushing Gemini-based security tools into vulnerability detection and patching. The broader security angle matters because AI is expanding the attack surface at the same time. It's creating defensive tools which support cybersecurity demand. One of the cleaner risk signals right now is retail leverage. Schwab reported margin loan balances up roughly 30% year over year, with core margin borrowing up about 50%, and some data showed record levels in June. Layer on heavy call buying, leveraged ETF participation, and crypto options speculation, and you have a market that can whip hard in both directions. This matters most on down days. When positioning is this levered and this one-sided, de-risking can be quick and disorderly. Crypto is still seeing a risk on tape. Bitcoin moved above $66,000. Call volume has been strong, and options positioning remains skewed bullish across exchange and ETF flow. At the same time, regulation is moving from abstract to actionable. Coinbase's CEO said a bipartisan Clarity Act is nearing completion, with federal consumer protection and enforcement implications. That's relevant because clearer rules tend to matter more than short-term price pops if you're judging whether institutional adoption can broaden. AI infrastructure is also becoming an energy story in a much bigger way. EQT estimates U.S. data centers powering AI could need an extra 10 to 18 billion cubic feet per day of natural gas. That puts electricity cost, transmission build-out, and fuel exposure directly into the AI economics debate. If compute demand keeps rising, the constraint may not be chips alone. It may be whether enough power can be built and financed without pushing costs higher across the system. Under the mega-cap surface, market breadth still looks less healthy than the index suggests. Apple, Meta, Amazon, and the chip complex are doing a lot of the lifting. Software is a separate pressure point. Companies like ServiceNow, Salesforce, Adobe, and IBM are facing questions about organic growth, legacy drag, and whether AI spend is additive or just replacing existing budgets. That concern is bleeding into private credit, where direct lenders are warning about elevated software loan defaults over the next few years as valuation multiples compress and leverage capacity shrinks. A few cross-asset signals matter from here. If the 10-year moves toward 5%, financing pressure rises across AI, software, and other rate-sensitive growth assets. Oil is another risk input. Middle East disruption and threats around Bab el-Mandeb have raised concerns about a sharp crude spike, and lower strategic petroleum reserve levels increase sensitivity to shocks. At the consumer level, strain is still building beneath the surface. More households report living paycheck to paycheck, even as bank credit lines remain available, and some investors are reportedly using margin loans for non-investment needs. That's the setup. AI demand is still strong, but the market is moving from build at any cost to prove it and finance it. The next big tells are cloud earnings, credit spreads, yields, and power economics. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.